Hello, my brilliant commerce stars. Welcome back to Commerce Made Easy by Aiswarya, your ultimate destination for turning complex accounting rules, business theories, and economic concepts into total child's play. Whether you are preparing for your Class 11 and 12 CBSE exams, tackling the Kerala state syllabus, or studying from across the Middle East, my goal is to make sure you don't just memorize the textbooks, but actually understand how the business world works. No boring lectures, no confusing jargon, just simple, real-life examples that make the concepts stick forever. Now, if you want to score full marks in your board exams, clear up your accounts confusion, and make your commerce life completely stress-free, do me a quick favor right now. Look down below and hit that subscribe button. Don't forget to turn on the notification bell so you never miss a new chapter breakdown. Give this video a big like right now to support free, high-quality education. And most importantly, share this channel with your classmates, study groups, and friends. Let's build an amazing community where we all learn and grow together. All done? Fantastic! Grab your notebooks and your calculators, and let's make commerce easy. Now, if you were with me in our last class, we laid down some serious groundwork. We cracked open the cash flow statement and covered all the essentials that the CBSE board loves to ask. We looked at the strict legal requirements under the Companies Act 2013 and why as 3 is mandatory. We broke down the 3 major classifications: operating, investing, and financing activities. And we talked about the core objectives and those 5 massive benefits a business gets from tracking its cash. Now, look, if you are sitting there right now thinking, wait, Aishwarya ma'am, I completely missed that video. Do not panic. I've got you covered. I have pinned the link to that first video right down in the comment box below. Seriously, go pause this video, click that link, and watch it first. I say this because you cannot build a beautiful house on a weak foundation, right? We want our conceptual foundation to be rock solid so that when we start solving the big, scary numerical problems, they feel like an absolute walk in the park. So, if you're all caught up and ready to roll, let's dive straight into today's session. But before we do, make sure you hit that subscribe button, give this video a big like, and share it with your study groups. Let's get into it. Alright, now that everyone is on the same page, let's unlock the very first term you need to know before we even touch a practical problem. It's right there in the title of the chapter, cash. Now you might be thinking, come on, Aishwarya ma'am, I know what cash is. It's the paper money in my pocket. Well, yes, but according to our favorite rulebook, AS3, the definition of cash is slightly broader, but still super simple. Under AS3, cash includes 2 main things. Let's look at them. First one is cash in hand. This is exactly what you're thinking. It's the physical currency notes and coins sitting right inside the company's office cash drawer. It's the liquid money you can grab right this second to pay for a delivery or buy office tea. Second one is demand deposits with banks. Now, this sounds a bit fancy, but it's actually just a technical word for the money the company has sitting in its current account or savings account at the bank. Why is it called a demand deposit? Think about it. When you take your debit card to an ATM, or when you open your banking app to scan a QR code and make a UPI or card payment, you are essentially telling the bank, hey, I want my money right now. You are demanding your deposit, and the bank has to give it to you instantly. There are no lock-in periods, no waiting for months. It's available to use immediately, just like physical cash. So, whenever you see the word cash in this chapter, don't just think about paper notes. Think about cash in the drawer plus money in the bank account. Easy, right? But wait, the chapter isn't just called cash flow. It's called cash and cash equivalents. What on earth does cash equivalents mean? Okay, so we know what cash is. But what about that second part? Cash equivalents. If you look at the word equivalent, it basically means equal to. So, cash equivalents are things that aren't literally paper notes or bank balances right this second, but they are so close to it that they might as well be. They are the next best thing to cash. According to AS3, for an investment to qualify as a cash equivalent, it has to check 4 specific boxes. Let's look at them like a checklist. Box 1. They must be short-term. We aren't talking about investing money for 5 or 10 years here. Box 2. They must be highly liquid. Highly liquid just means you can sell them and get your money almost instantly. If you have to wait weeks for someone to buy it, it's not liquid. Box 3. You can easily convert them into a known amount of cash. This means you know exactly how much money you will get when you cash them in. No guessing games. Box 4. They carry a very low risk of change in value. This is the big one. Their value is incredibly stable. Let's use a funny, real-life example to understand this. Imagine you are starving and you go to a fast food counter to buy a burger. You realize you forgot your wallet and your phone is dead. But you happen to have a shiny gold coin in your pocket and also a gift card for that exact burger shop worth 500 rupees. Now, both are valuable, right? But can you hand the gold coin to the cashier for a burger? No. The cashier will say, "Ma'am, I don't know how much this gold coin is worth today. The market price changes every hour, and I can't check it right now." Gold carries a risk of price change. But if you hand them the 500 rupee shop gift card, boom! It's short-term, you know its exact value, 500 rupees. It's not going to suddenly drop to 200 rupee tomorrow, and the cashier accepts it instantly. That gift card behaves exactly like cash. That is a cash equivalent. Now, in the corporate world, companies don't invest in burger gift cards. They invest their extra cash in specific financial instruments to earn a little bit of interest rather than letting it sit idle. For your exams, you need to remember these 3 classic examples of cash equivalents. If you see these in a question, treat them just like cash. First one, short-term investments with a maturity of 3 months or less. This is the golden rule of AS3. If a company buys an investment, and it is going to mature, meaning it turns back into cash, in 3 months or less from the date they bought it, it is a cash equivalent. If it takes 4 months, it's out of the club. It must be 3 months or less. Second one, Treasury bills or known as T-bills. Think of Treasury bills as a company lending money to the government. Because it's the government, it's incredibly safe. There is zero risk of them running away with the money, the value doesn't jump up and down wildly, and you can convert them back into cash whenever you want. Third one, short-term marketable securities. Marketable just means these are shares or bonds that can be bought and sold on the open stock market in literally 2 seconds. Because they are short-term and highly stable, the company can sell them today and have the cash in their account by this evening. So, when we combine everything from today and our last class, total cash is equal to cash in hand plus bank deposits plus T-bills plus marketable securities plus 3-month investments. Alright, now pause right there. Pull out your notebooks and write this down in big, bold letters because this is exactly where the CBSE board loves to set a trap for commerce students in the exam. We know what goes into the cash equivalents bucket. But what gets kicked out? What is not treated as a cash equivalent? Let's look at the 2 biggest culprits. First one is the equity shares. Imagine our friend Rahul from the last video decides to invest his company's extra cash into buying shares of a trendy tech company on the stock market. He thinks, hey, I can sell these shares anytime I want, so it must be a cash equivalent. Wrong. Sorry, Rahul. Why are normal shares not cash equivalents? Remember our checklist? Box number 4 said, very low risk of change in value. The stock market is a wild roller coaster. Rahul could buy shares for 1 lakh rupees today, and by next week, a piece of bad news could drop, and those shares might crash to 40,000 rupees. Because the price jumps up and down like crazy, equity shares carry a high risk. So, normal shares are strictly not cash equivalents. They are just regular investments. And the second one is long-term investments. This one is pure common sense. If a company buys a government bond or puts money in a fixed deposit that is locked away for 3 years, 5 years, or even 1 year, it completely breaks our golden rule of 3 months or less. If you can't touch the cash for years, it's a long-term investment, not a cash equivalent. But wait, this is accounting, right? And what is accounting without a sneaky little exception to the rule? There's one special type of share that can sneak into the cash equivalents club. Write this down. Preference shares acquired shortly before their redemption date. Let's translate that into normal human English. Imagine another company issued preference shares, and they promised to pay the money back, which is called redemption, on 31st December. Now, our company comes along on 1st November and buys those preference shares. Let's do the math. From 1st November to 31st December is just 2 months. Because we bought them so close to the payback date, two awesome things happen. It meets our 3 months or less rule. The risk is insignificant because the company is legally about to return the exact stated amount of money in just a few weeks. The market price doesn't have time to go crazy. So, because the risk is super low and the time is super short, AS3 says, okay, fine. You can treat these specific preference shares as a cash equivalent. It's like buying a movie ticket from someone standing in the queue just 5 minutes before the show starts. You know you're getting in, the price is set, and there's no time for anything to go wrong. Thank you so much for watching Commerce Made Easy by Aiswarya. You're doing great, keep working hard, and I'll see you in our next video where we finally start classifying real transactions.